Chapter 15 is all about forming and operating partnerships. So, we've talked about the concept of flow-through entities, when we were distinguishing corporations from partnerships, from LLCs, from S-corps, and the basic concept is not that the entity does not exist in the eyes of the IRS, simply that when the entity files a tax return with the IRS, it is an informational return where the entity, the partnership, or the LLC will tell the IRS this is the taxable income we had, all of this good stuff. And it will let the IRS know then who that income is allocated to from the owners. So there'll be a form that says, hey, this is our taxable income for the partnership, and it's allocated in this way to these owners. And of course, the owners would also get a form from the entity showing that allocation as well. So all that to say that the concept of flow-through just means that the income will, or at least the tax consequences of earning income, flow through to the owners. Let's see. The whole aggregate versus entity approach is really just terminology, so I'm not going to talk too much about that. It really just goes to how you think about partnerships or flow-through entities. The effects of both are pretty much the same. So obviously, similar to when a corporation is formed, or I guess in the initial public offering of a corporation, well, I guess it wouldn't happen as often there. What I'm getting at is similar to some of the times when you would trade cash, assets of other types, land, buildings, etc., in exchange for some portion of ownership interest, usually stock from a corporation. Similar to that, partners buying into a partnership, whether it's at the outset when it's formed or later on down the road, will trade cash or services or property in exchange for ownership interest in the partnership. Obviously, that carries some rights and responsibilities, liabilities, etc. When you buy into a partnership, you're generally getting the right to receive some share in the partnership assets, assuming that the partnership ever had to liquidate, which would be called a capital interest, similar to your share. If you're a stockholder, common stockholder, you have the last stake in the company. Once it liquidates everything, whatever's left, you have some share in that. But as far as partners or partnership members go, they also have the right to future and present. Future profits and present profits, future losses, present losses, and obviously a much more direct interest in that than a shareholder would in a corporation. If all you're getting is the right to receive future profits or to share in profits and losses in the future, that is called just the profits interest. So oftentimes partners who are not actually contributing anything other than their time will receive that, representing the fact that they're essentially trading their time for future percentage of future earnings potential. Similar to when corporations are formed, the realization in the corporation's eyes of gains and losses from exchanging contributed property for stock, and in this case for partnership interest in the case of partnerships, generally going to be fully deferred or at least either partially deferred for tax purposes, basically similar to when we talked about it before. If we're basically saying you're using that property to buy an ownership interest in the entity that is now owning that property, so you're essentially giving it to yourself, or at least a portion of it to yourself. So the rationale is that the owner of that property still is the contributor, or at least that contributor maintains ownership in that property to some extent until it's eventually liquidated. That is, until it eventually leaves the partnership's hands. I already talked about this stuff here. Initial tax basis, basically the sum of tax basis of any property and cash that that partner is then entitled to. Of course, if the partnership has debt, then it is required that each partner recognize a percentage of that debt in computing initial tax basis. Let's see here. We can distinguish in those debts between that the partnership may have between recourse and non-recourse debts. If it's a recourse debt, then the individual partners, basically recourse means beyond the partnership level. So could the individual partners have economic risk of loss? If so, then it's a recourse debt. If not, then it's a non-recourse debt. Again, just more of a terminology thing. And as is typical, if you contribute property to an entity and your basis in that property is lower than the debt that you carry, whether the property carries that's also being assumed by the entity, then whatever the difference is, we're assuming, we're calling that a gain to the partner donating it or contributing it, I should say. Because we're just assuming that there's something else going on there. Otherwise, why would the corporation be willing, or the partnership be willing to assume a debt for something that's less than the value of that item? Obviously, basis does not equal fair market value, but it is what it is. All right, let's look at some examples here. Okay. When CCS was organized early in 2010, Nicole contributed $10,000 of cash and land with a fair market value of $150,000 and adjusted basis of $20,000 to CCS. The land was encumbered by a $40,000 non-recourse mortgage executed 3 years before. Recalling that CCS already had $60,000 in bank debt before Nicole's contribution, what tax bases do Nicole, Sarah, and Chan's Inc. initially have in their CCS interests? How do we allocate that? Let's see. The bases are 36,666, 146,666, and that again for Nicole, Sarah, and Chance Inc. respectively. And it is broken out as you see here. Basically, the only real trick to that would be how are you dividing up the debt. So you see here the various shares of the recourse bank loan divided equally here, and then the non-recourse mortgage, the component that is shared equally, and then the non-recourse mortgage in excess of basis and contributed land, and then finally the recognized relief from the mortgage debt, where the mortgage exceeded basis by $40,000 for Nicole. Next example. Assume Sarah and Chance Inc., but not Nicole, personally guarantee all $100,000 CCS's debt, the $60,000 bank loan, and the $40,000 mortgage on the land. How much gain, if any, would Nicole recognize on her contribution to CCS, and what would be the basis in her CCS interest? All right, so she had the same $20,000 basis in the contributed land, cash contributed. Her share of the debt would be 0 there. So debt relief would be $40,000 and $10,000 based on the amounts in excess of basis and contributed land and cash, and debt relief there. So we would recognize that $10,000 in capital gain from the debt relief in excess of basis and contributed land and cash, which obviously is just that amount turned around and turned into a positive number, which effectively just cancels that out and causes this to zero out. Now, I already talked a little bit about the difference between a capital interest and profits interests. The fact that, contributing services could have either of those types of interests. Let's take a look at this third example, services for capital interest. December 31st, 2010, all members of CCS agreed Sarah would receive an additional capital interest in CCS with a liquidation value of $20,000 and an increase in her profit and loss sharing ratio from 33.33% to 40%, leaving the other members with a 30% share of profits and losses, to compensate her for the time she would spend on an additional project. At this point, CCS's debt was $100,000. What are the tax consequences to Sarah and CCS of giving her an additional capital interest? Well, Sarah here is going to have to recognize in ordinary income whatever the liquidation value of the capital interest is. In this case, it's $20,000. And that amount would basically be taken away from capital of the other two partners. Now, assuming Sarah received only a profits interest for her services instead of the capital interest that we just talked about in the last example, what would each entity's tax consequences be? So Sarah would not be required to recognize any income. CCS would not deduct or capitalize any costs. As CCS generates profits in the future, Sarah receives a greater share of the profits than she would have otherwise received, and the other two members receive the whatever corresponding amount to the amount that she receives that's a greater amount is split up between the other two. In addition, the increase in Sarah's profit and loss sharing ratios go from 33.33 to 40%. Debt allocations among the partners change to reflect Sarah's additional entitlement. Let's see here. Anything else we need to talk about on this slide? All right, moving on. If a partner is buying into a new partnership, then obviously you need to know that partner's initial tax basis in the partnership. And that would be whatever the purchase price is, plus you take the total partnership debt and you allocate the appropriate portion to the partner as a new partner in the partnership. So, depending on whatever portion of the partnership you're purchasing, that's a tongue twister. Whatever portion of the partnership you're purchasing, that will determine obviously the portion of the partnership debt that you are going to be responsible for. Excuse me. All right. Just a nice reference slide for holding period and basis. Now at the partnership level, a lot of the elections for tax purposes are made, and then, like I said, the various tax effects of those elections would be allocated out and passed through to the individual entities, or the individual owners, I should say. Yeah, I mean, you guys pretty familiar with accounting methods by this point in your accounting journey, I hope. So there are some partnerships still that are using the cash method. If they have no incentive to be more sophisticated in their financial record keeping and use the accrual method, which is more expensive, then they will or have the option at least of using the cash basis. Yeah, that can result in some kind of funky deferrals, which I'm not going to talk too much about. Some still, more of the same discussion there. Basically, when reporting at the partnership level, all items are going to be separated into ordinary business income and then anything else. And anything else will be a separately stated item, and that is because it will be treated as something other than ordinary business income or loss. These are just some a non-exhaustive list of some separately stated items. Just as we talked about last week, sometimes there are going to be guaranteed payments where an individual partner receives X amount of dollars right off the top before other components are divvied up of partnership income. And those are paid regardless of profit or loss earned by the partnership. So that has some unique characteristics, which you see there. LLCs are very often treated as general partnerships with respect to self-employment tax rules. Under these circumstances here listed, we know we've got the net investment income tax, and occasionally we'll have some items that are separate items that would be partnership incomes, and you see some examples of those there. We already talked about the fact that even though partnerships don't pay taxes at the partnership level, that doesn't really cut down all that much in the reporting requirements by the IRS. Obviously different types of forms, different form numbers, etc. But ultimately what we report is income, taxable income, etc., deductions at the entity level, and then those will be allocated out and passed through to the partner. At the end of each year, partners will make adjustments to their tax basis in the partnership, so that obviously if during the next upcoming year they were to sell their interest, that would need to be up to date. So in order to keep it mostly up to date, at least to where only what's happened during that year needs to be updated, it's updated on an annual basis. And these are the ways that partners, or the adjustments that partners make in their bases on an annual basis to account for the occurrences that have happened during the year. Now for partnerships, they are taxed at the entity, or I'm sorry, at the individual level. So the individual owners, the partners, are taxed when the money is earned. So the year that it's earned, partnerships can't just sit on money much like a corporation would sit on retained earnings and just avoid paying it out to owners so that it doesn't get taxed. That can't really happen for partners because they're taxed when the money's earned. So even if the partnership, at the partnership level, if the money stays in the partnership's bank account and none of it goes out to the partners, they still, in their own individual tax returns, have to pay taxes on whatever their percentage of that income was. So obviously it's a pretty big disincentive to keep money within the partnership. Makes it, one of the reasons it makes it difficult to grow into a really big entity. But the positive to that is, well, I guess just the other side of it really, is that when that money actually is distributed, assuming it's not in the same year, then it is not taxed when it's distributed. Now, obviously, there are some benefits to being a partnership, and one of those is the usability of partnership level operating loss at the entity level when it's passed through to the partners on their individual tax returns, because ordinary losses from partnerships are deductible against any type of taxable income on an individual's tax returns. So if the partnership had a loss and that is coming through to the individual partner, and the individual partner had some other income that is totally unrelated to that, say maybe from just a salaried job somewhere else, they could actually use that to offset use the loss from the partnership to offset their income from the other jobs. So you can see how that can be a pretty good advantage there, though there are many disadvantages. You're limited to your overall basis in the partnership and the amount of loss allocation that you can use from the partnership. Not too much to say about this one. This particular limitation comes up often in the rental real estate world, but it's basically where you, if you're not in certain situations where rental real estate just happens to be one where it's very common, you may not actually be actively participating. Basically for, rental real estate, you generally buy the property, sit back, maybe advertise a little, a couple hours a week, think Airbnb, hire someone to come clean it, but not really spending a lot of time with it. That would be considered a passive activity, and so you'd be limited in the amount of losses that you could, well, not in the amount, but in the usability of the losses that you incurred in those types of activities. It's a little bit beyond the scope of what I want to talk about, but this is a slide that shows the kind of flow chart to determine whether you materially participated, so whether or not you'd be subject to the passive limitation for losses. All right, that's the end of this slideshow for this chapter. We'll see you for the next one.